Hi everyone, just doing a quick sound check here while we wait for a few more people to join. Could I get some responses in chat just to confirm that you can hear me? Just doing an audio check. Can everyone hear me? We're waiting for a few more people to turn up before we begin. Excellent, excellent. Going to wait for another minute or so, and then we'll begin. Just waiting for a few more people to join. We do have 30 minutes, so we have to start soon. We'll give the other guys just a few more minutes. Okay, so it looks like most people are joining now, and I will be doing recap slides along the way, so anyone who does join a bit later can hopefully follow along from those recap slides when they surface. Could I please get you to confirm if you can see my screen? Darwin, DWC, real-time sentiment index, and security. If one of you could please just type yes into chat, that should help me here. Brilliant. Thank you very much. So I think we can begin. And as more people join, they'll be able to follow along with recap slides that we'll be putting forward as we progress through. So firstly, welcome. Thank you for attending this webinar. We have approximately 30 minutes. We'll need 30 to 40 minutes to complete the presentation. Quite a bit of material to cover, so I'll skip over most things in terms of pleasantries and dive straight in. And before we do begin, though, there are some prerequisites for this presentation today. It is assumed that attendees have a working knowledge of Darwin investment attributes. These include experience, market correlation, loss aversion, etc., that you may be familiar with, are familiar with from Darwin listings on the platform. It's assumed that attendees have a working knowledge of a Darwin's trading journal, including statistics interpreting things like deleverage and open trades, and that you have some investing experience. That could be in Darwin's, it could be in stocks, commodities, foreign exchange, whatever the asset class. As long as you have some investing experience coupled with a working knowledge of Darwin investment attributes and trading journal statistics, we should progress absolutely fine. In terms of agenda, we'll be starting with observations and analysis that led to identifying the need for Darwin DWC to begin with. We'll follow that up with how we used those observations and analysis to construct the model, defined requirements for the model, did the implementation based on those requirements, and how we drew conclusions and what we drew from the implementation. We'll follow that up with a very brief discussion on the robustness of the model from both quantitative as well as fundamental standpoints to assess the nature and reliability of the model. Finally, concluding with what's in it for passive Darwin investors. What does DWC mean to a Darwin investor? Where does it fit into the scheme of things in Darwin investing in general? Once all of that is done, we'll have a Q&A session where I highly encourage all of you to answer, to put forward your questions for being answered. And if you could please do me a favor, in the interests of conserving time, if I could kindly request that all of you keep your questions for this Q&A session at the end of the webinar, we'll be able to proceed quite well. So let's begin with the observations that led to identifying the need for Darwin DWC. To begin with. So since launching the brokerage offering in 2014, at Darwinex, we've observed a recurring pattern in the Darwinex Trader Collective. And this pattern is composed primarily of two cycles. A benign cycle that lasts usually 3 to 4 months and is a period where Darwins generally experience good performance, or performance that's as expected of those Darwin portfolios. And this period is immediately followed by a sweep cycle that lasts 2 to 3 months, where those same Darwin portfolios experience underperformance. And this pattern demonstrated itself in persistent fashion. So to demonstrate what this looks like visually, I've put together this hypothetical illustration for you, where the blue time series, the blue curve, essentially represents the growth of a Darwin portfolio. And in the middle, I've marked out a 3 to 4 month period for you that represents such a benign cycle where Darwin portfolios generally experience growth, followed by a sweep cycle of lasting 2 to 3 months where those same Darwin portfolios experience declines. And this behavior is something we observed in the Darwinex Trader Collective. So naturally, observing this being persistent, it raised a few questions. Firstly, what causes this behavior? And secondly, is this behavior systematic? Because if it is systematic, then it allows us to see if there is a solution that we could look into that could benefit both Darwin investors and Darwinex investing in Darwins during these periods, particularly during sweep cycles when we observe that Darwin portfolios experience underperformance. So that led us with these observations into the analysis phase, where we started looking into the community data to see if we can find more detailed explanations for why these cycles present themselves, the benign and sweep cycle phases that show themselves regularly in the Darwinex Trader Collective. And what we found was that traders in the Darwinex Trader Collective routinely demonstrate loss aversion during significant market trends, during particularly strong market trends. For example, when a market trends, loss-averse traders tend to take quick, small profits in line with the trend. But any trades that have gone bad, that have gone against them, that they've taken against the trend, they let them run for as long as possible, over a few days, sometimes into a few weeks, sometimes even a few months. And that this behavior defines loss aversion, is by definition loss-averse behavior. I have put together some data for you from the 16th of April to the 16th of May, real data from the community, as well as using an example for EURUSD during that time to show you how this looks in practice. But before I move to that chart, I'd like to just say that if you are interested in reading more into psychological mechanisms and cognitive biases such as loss aversion, I highly recommend a book called Thinking Fast and Slow by Nobel Prize winner Daniel Kahneman, and it discusses at length some of the most highly researched phenomenon along these lines in economics, finance, and other circles. So moving on to the chart that I just mentioned, this chart I've put together for you contains real data from the 16th of April to the 16th of May of this year, 2017, where the top time series in blue represents the EURUSD's market price during this period. Notice that it is in a significantly strong uptrend between the 16th of April to the 16th of May. The time series in orange below it is the Darwinex community's exposure to the euro during that time. And what's instantly visible is that while the EURUSD was in a strong uptrend, the Darwinex community appeared to consistently be shorting the EURUSD throughout that time. And this is in line with loss-averse behavior, where we can clearly see that in an uptrend, when bad trades are taken, those bad trades are being held for as long as possible, and this behavior is manifesting itself in this chart here, where the community's exposure is declining as the EURUSD is rising. There are brief periods where the community's exposure is in line with the trend, so very brief periods where the community's exposure rises as the EURUSD is rising. Both these behaviors are in line with the definition we just put forward of loss-averse behavior, where quick, small profit taking in line with the trend happens, as well as letting bad trades that have been taken against the trend run for long periods of time. Moving on to what this behavior presents in terms of problems, during deep, tough tail movements, during sweep cycles of the likes that present themselves during these significantly strong trends, investors experience poor performance because Darwin portfolios perform poorly due to this loss-averse behavior. Secondly, Darwinex is a DMA broker, and as a DMA broker, we lose business when our customers lose. Thirdly, as a prop investor, Darwinex, just like Darwin investors, Darwinex is a Darwin investor itself. As a prop investor, when we invest in traders and those traders lose due to this loss-averse behavior, we in turn lose as well. And fourthly, the only people in this entire scenario, a sweep cycle, during sweep cycles, the only people to benefit from the suffering of the Darwinex trader community are the liquidity providers. So in conclusion, looking at all of these observations and analyzing them, we concluded that all Darwin investors, and this includes Darwinex as a prop investor in Darwin's, could benefit from a solution that, one, allows us to hedge risk during such periods, and two, it would be great if it could help us anticipate new market cycles. So one, we're looking for a solution that could help us eat into the risk, hedge away some of the risk or all of the risk depending on our allocations. And secondly, it would be invaluable if it could also allow us to anticipate new market cycles. So with the observations and the analysis under our belt, we went towards constructing the model and defining requirements for that model. Before I continue there, for people who've joined again just recently, we've gone through what benign and sweep cycles are defined as in terms of the Darwinex Trader Collective's behavior. A benign cycle is a period of 3 to 4 months where Darwin portfolios generally experience good performance, followed by a 2 to 3 month sweep cycle where Darwin portfolios experience underperformance. And we went ahead and showed how this looked in practice using real data from the community and the EURUSD currency pair between the period during the dates April 16th to May 16th of this year, where we showed that during a strong uptrend in the EURUSD, the community's exposure to the euro during that strong uptrend demonstrated consistent decline. The community appeared to be shorting the EURUSD exactly during the time when the EURUSD was experiencing a strong uptrend, all elements in line with loss-averse behavior. So in terms of requirements for a solution that would allow us to hedge risk and anticipate new market cycles, such a solution would need to trade the opposite of loss-averse behavior. If it's loss-averse behavior that's resulting in the Darwin portfolios declining during sweep cycles, it made sense that the solution that we present should be able to trade the opposite of this loss-averse behavior to hedge risk during such times. Secondly, the solution would need to be a tradable asset itself. That is, it would need to be a Darwin. And the reasons for it needing to be a Darwin were, firstly, to hedge a portfolio of Darwins, you would need another Darwin. So to be able to hedge the portfolio as and when necessary, a hedging Darwin would be essential. Secondly, it would need to be a Darwin because it would then have the same risk as any other Darwins in the portfolio, currently 10% value at risk, making it easier for investors to calculate how much to invest in the hedge as and when necessary. And thirdly, and most importantly, the instrument, the hedging Darwin, would be created leveraging Darwinex community data, which is owned by the community. So it must be a Darwin so that when that Darwin is used, the community needs to be compensated therefore using that Darwin in the form of performance fees from profits gained from that Darwin. So the most important point behind it being a Darwin, needing to be a Darwin, was that it would allow us to compensate the owners of the data, the Darwinex community. More with requirements in terms of logistics, the Darwin would need to execute the smallest number of trades at all times. And this is essential because it's a hedging strategy, and if it executes too many trades, then there would be increased transactional costs that would eat into the hedging assets returns. So to minimize transaction costs that could eat into the hedging assets returns, the Darwin would need to execute the smallest possible number of trades. And it was also decided that the Darwin must trade only currencies. This isn't by definition a must, but the decision to make it trade only currencies was influenced by the fact that more than 95% of the Darwinex trader community trades currencies. Therefore, it made sense that the hedging Darwin should also trade just currencies. So with the observations, analysis, and requirements defined, we now moved on to the implementation. And we've now ascertained from this discussion, I've shown you charts that have demonstrated what loss-averse behavior looks like. It's clear that loss aversion creates asymmetry in the community's currency exposure during significant strong trends in the market. And asymmetry is defined as the loss aversion in the Darwinex trader collective creates asymmetry. So uneven distribution of exposure on either side of the currency is what the hedging Darwin would need to address. So in the implementation, DWC measures the exposure of the Darwinex trader community, firstly, in each currency. These major currencies include the euro, the British pound, the US dollar, Canadian dollar, Japanese yen, Swiss franc, New Zealand dollar, and Australian dollar. And it's when the currency exposure turns asymmetric that DWC trades opposite to this asymmetry. Remember, taking a look at this chart again, here we have an example of the EURUSD in a strong uptrend and the community's exposure in a strong downtrend during that same time. So the community there is an asymmetry created as a result of this loss-averse behavior that DWC would need to address when executing trades. And when DWC did execute trades during that period, notice the performance of the DWC versus what the community was doing versus what the EURUSD currency pair was doing at that time. So again, at the top, we have the blue time series representing the EURUSD market price between the 16th of April and the 16th of May. In the middle, we have the orange series representing the community's exposure to the euro. As you can see, asymmetric decline. And during that same period, the DWC demonstrated gains of nearly 14.5% to 15% because it was addressing the asymmetry created as a result of this loss-averse behavior. So were an investor to have been hedged with DWC in their Darwin portfolio at that time, between the 16th of April to the 16th of May, remember this is real data, then that investor would have been able to claw back some of the losses as a result of Darwin underperformance. And depending on the allocation to DWC, that investor may have been able to avoid a majority share of that risk altogether. But it's all down to allocations at the end of the day. But this chart clearly demonstrates that DWC was able to successfully address the asymmetry created in the community as a result of loss-averse behavior. So during benign cycles, we've seen now from that chart that during benign cycles, the community prospers, and in line with the community prospering, the DWC suffers. During sweep cycles, as we just saw in the previous chart, the community suffers as a result of loss-averse behavior, and the DWC prospers. Overall, though, the DWC prospers more during sweep cycles than it suffers during benign cycles, which is great because then it makes it a decent hedge for investors during sweep cycles and also presents itself as a hedge during benign cycles where, just to be on the safe side of things, DWC can be given an allocation in a portfolio. So the conclusions we've drawn now from having done the implementation, defined the requirements, implemented them, we've addressed, after looking at all of this information and discussing all that we have today, that loss aversion is indeed systematic in the Darwinex Trader Collective, and that DWC behaves in a manner that is reflective of the community's disposition at any given time. So it therefore serves as a valuable leading indicator of community sentiment. In a benign cycle, DWC will be declining, and in a sweep cycle, DWC will be rising. But the real value in the leading indicator bit will come in a few slides later when I talk about how to look at the open trades and deleverage aspects in DWC's trading journal in order to really extract that valuable leading indicator value from the DWC. DWC, by definition, DWC models a cognitive bias, a loss aversion, that has limited degrees of freedom by definition. So, and this behavior manifests itself in DWC because if you've seen the DWC returns curve on the platform, it is a fairly stable range. So the cognitive bias, by modeling the cognitive bias, the behavior manifests itself quite well in DWC's mean reverting nature. It ebbs and flows with the community sentiment in a fairly stable range. So with all of that in mind, the next question that comes forward is, well, how robust is the model? What can we use to feel better about the analysis, the implementation, the results that we've seen so far? And to assess the robustness of the model, we did that from two standpoints, the quantitative standpoint as well as the fundamental standpoint. I won't bore you too much with the quant tests that we did, but we did publish the research on our blog. Please visit blog.darwinex.com, where you can see statistical mean reversion tests that were conducted on the DWC time series. It's available on this blog post if you can see the link on this slide. If you can't, or it's hard to copy it, just go to the Darwinex blog and in search bar or in the labs category, search for mean reversion tests DWC, and that should allow you to see all the research that we've published there for this particular, the quantitative testing that we conducted for robustness. For those of you on the webinar who are interested, for a quick summary on what those entailed, we were able to successfully see autoregressive behavior, model the DWC time series as an autoregressive process. We saw stationarity in its standardized residuals. Autocorrelation came out stable. The normal QQ plot of standard residuals also demonstrated very acceptable deviations at the extremes, and the Young-Box statistics showed positive, favorable probability values. From a fundamental standpoint, DWC makes sense. And the reason for that is that, as we discussed, liquidity providers are the only ones profiting when the Darwinex trader community is in decline. During a sweep cycle, Darwin portfolios experience underperformance and losses. It's the liquidity providers who gain from that period. So, because DWC's movements resemble what liquidity providers experience during such periods, during sweep cycles where Darwin portfolios are underperforming, this is a huge advantage to Darwin investors, because by being invested in a hedging Darwin such as this during such periods, investors automatically benefit from movement that is in line with what liquidity providers are experiencing during those periods. So it's quite powerful in that respect that DWC is able to demonstrate behavior in line with what liquidity providers are experiencing during troublesome periods. And in terms of risk volatility of the asset itself, DWC compared to any other asset is very low in terms of volatility. Likelihood of volatile movements in DWC compared to other foreign exchange assets that are being traded on the Darwin exchange, the likelihood of volatile movements in DWC is low because it opens a large number of trades on a large number of currencies. It opens trades on a large number of currencies simultaneously. This claim can be observed, can be validated by visiting the behavior data of Darwin DWC, where you'll see that the excursions are in quite a stable range and quite acceptable levels. So the average positive excursion for the DWC is 0.5%, the average negative is -0.03, best positive excursion at 0.48, worst negative at 0.26, and average number of trades per day at 16. Finally, having discussed the observations, an analysis that led to constructing the model, We defined the requirements, we conducted the implementation, we decided that DWC needed to hedge risk by addressing asymmetry created due to loss-averse behavior during significant trending markets, and we drew conclusions from all of that implementation, requirements, and analysis. Well, what at the end of the day is in it for passive Darwin investors, not active Darwin investors who could trade the asset within its mean reverting range, but what about passive Darwin investors? How does DWC fit in to the scheme of investing in Darwin's? And the first clues that are immediately visible are when you visit the returns and risk graph of the DWC, which provides actionable intelligence in real time. It's clearly visible from the returns risk graph that DWC is in decline during the community's prosperous periods, and DWC is rising when the community is suffering. To turn this into a bit of a hypothetical scenario, let me move to the next slide where I can make more sense to you of how this benefits investors. So if we were to model the DWC as this hypothetical curve, it's at a historical peak of the DWC that it makes sense to be invested mostly in Darwin's and not DWC, or at least have a lower percentage allocation to DWC. And the reason for that is that a historical peak on the DWC represents an end to a sweep cycle, which means that good times are ahead for Darwin portfolios in general. Therefore, it makes sense to have a lower allocation towards DWC when it has approached a historical peak. When the benign cycle continues and reaches its termination or close to its historical troughs, it makes sense to begin considering higher percentage allocations to DWC as opposed to other Darwins in your portfolio, because a historical peak in a historical trough in the DWC is symbolic of more difficult times coming up ahead, or saying that the probability of a huge market trend up ahead has increased quite a bit. And we know from all that we've discussed today that during significant market trends, the Darwinex Trader Collective is prone to demonstrating loss-averse behavior that then creates asymmetries that cause Darwin portfolios to underperform. Now, in terms of how to gauge whether a trend is around the corner or a benign cycle or a sweep cycle is around the corner, invaluable information presents itself in the DWC's open trades and deleverage charts that are visible in its underlying strategy. If you visit those charts, you'll see that as the number of open trades decreases in the DWC, the probability of a huge trend increases. So open trades therefore help anticipate an upcoming growth phase in DWC, or in other words, a new sweep cycle, a new winning cycle in the DWC around the corner. Let me move to the larger graph here for a second. As I mentioned earlier, as the number of open trades decreases, the probability of a huge trend in the market increases, thereby increasing the odds of a new sweep cycle coming shortly. When a new sweep cycle comes shortly, DWC is prone to rising during that period. So by using open trades and deleverage to your advantage in this manner, you can therefore predict or start changing your allocations accordingly in anticipation of a new market cycle ahead. Investors should be particularly careful when considering Darwin's with low scores for loss aversion. So this typically would filter into a loss aversion score of less than 4 or 5 and a capacity score of greater than 4 or 5. Such Darwins are prime candidates for hedging with DWC, as they are most adversely affected during sweep cycles. Any Darwin that has a loss aversion score of less than 4 and a capacity of greater than 5 is likely to demonstrate loss averse behavior, where they engage in quick profit taking with the trend, but let any bad trades that have gone against them run for as long as possible. Typical observations that you'll see in loss-averse Darwins can be found under their behavior. Say you've picked a loss-averse Darwin, let's call that XYZ. I'm not sure if that's a Darwin, but say Darwin XYZ is a loss-averse Darwin with a loss aversion score of less than 4 and a capacity of greater than 4. Visiting its behavior and looking at its max positive negative excursion per trade, including open trades, you'll notice this sort of behavior, where you have massive negative excursion followed by recovery in massive negative excursions that demonstrates this sort of pattern, followed by yet again that repeating itself cyclically over time. Secondly, if you click on the loss aversion badge on a Darwin, on any loss averse Darwin that you filtered out, you'll see that their position excursions resemble this sort of behavior, where you'll have stable position excursions followed by massive adverse effects, adverse negative excursions, then stability again, and then massive negative positive excursion, stability again, and this cycle repeats itself. So these are clues for you to identify loss averse Darwins or cater to loss averse Darwins as and when you filter them out. Finally, a Darwin that has a loss aversion score of less than 4 or 5 and a capacity of greater than 4 or 5 is very likely going to be negatively correlated with DWC, but not always. So it's always a good practice, if you are looking at a Darwin that has a loss aversion score of less than 4 and a capacity of greater than 4, it's a good practice to go into its correlation tab, enter DWC under correlation, and check its correlation with DWC. Odds of a highly loss-averse Darwin being negatively correlated with DWC are always quite high. Just a bit more about DWC as a Darwin. We've had these questions in the past, and to clarify, all DWC trades go directly to the market, exactly the same as any other Darwin on the exchange. So DWC is no different to any other Darwin. Darwinex never trades against traders. DWC essentially models behavior, as we've discussed in this webinar, and it is a strategy then tackles that behavior accordingly. It's by no means anything else. So it's exactly the same as any other Darwin in that respect. DWC also poses there is no conflict of interest by having DWC, because firstly, DWC is a Darwin that's available to the Darwin investor community, which includes Darwinex. So by having DWC in your portfolio, say particularly during a sweep cycle, it hedges the investor's portfolio against excess risk, which is a win for the portfolio, which is a win for the investor. During a sweep cycle, Darwinex loses less business as a result of more investors hedging off excess risk with DWC. And finally, as a prop investor ourselves, Darwinex hedges its own prop investment risk with DWC during such a time as well. So it's a win for everyone, for the Darwin investors and for Darwinex, and it allows interests to be aligned across the board. In terms of compensation, as we discussed earlier, one of the reasons for having the solution, for needing the solution to be a Darwin, was that because community data would be leveraged to create the hedging Darwin to begin with, the community would need to be compensated for that data being used. So Darwinex, like with any other Darwin, Darwinex collects a 20% performance fee on profits generated with DWC, as with any other Darwin on the exchange. And all performance fees that are collected, all of them are paid back to the Darwin provider community via the Darwinia competition. Some quick examples of how the DWC fared during some particularly difficult times. This is a graphic from the GBP Flash Crash of October 2016, where on the 7th of October we saw a decline of close to 1100 to 1200 pips in a very short period of time that, as you can imagine, created mass asymmetry. It's very interesting to see that DWC during that time rose approximately 10.67%. So had investors been hedged with DWC during such a time, a lot of the excess risk that was created as a result of the GBP Flash Crash would have been averted. Again, this is not to say that the DWC is designed to cater to these events. It's just a very good example to demonstrate how, when mass asymmetry is created, a hedging Darwin such as DWC is able to counter that mass asymmetry by doing what it's done, as we've discussed today. So today we've covered, starting from the observations through to the analysis, why we needed a hedging Darwin to begin with. We went ahead and discussed the model, the requirements that were defined for it, how we implemented it, and what conclusions we drew from it. We had a brief discussion on the robustness of the model from both quantitative as well as fundamental standpoints. And finally, we talked about what's in it for passive Darwin investors. What does DWC mean to Darwin investor portfolios? Why is it important, and why it's particularly important when Darwin portfolios are suffering. So thank you very much for your time and patience. Hopefully I've been clear. And if you have any questions, now is the time to please bombard me with all of them. Okay, I'm taking a look at questions here. Yes, loud and clear, all good. Thank you for the webinar, nice webinar. Okay, I'm still looking for questions. No questions. Really? Okay. How am I to know when to increase DWC? Right. So we have a question from Alan and Kathy. The question says, how am I to know when to increase DWC? Very good question. So let's go back to the slide that will help us with this particular question. We opened up a slide earlier on where, yes, the hypothetical example. So earlier on, I was talking about how if we model the DWC in this particular fashion, where with historical peaks and historical troughs, increasing your DWC allocation would make sense when DWC approaches a historical trough in its cycle. So you know that the DWC is operating in a fairly stable range, and as DWC approaches a historical trough, in allocating higher to DWC makes more sense. So a higher percentage allocation to DWC is warranted when it's closer to a historical low. That's one thing to take note of. The second thing to take note of, and more importantly, is DWC's open trades and deleverage. So as, I'm sorry, let me skip to that slide and start from there. So with open trades and deleverage, when you visit the underlying strategy of the DWC, if you observe that open trades are declining, that is an indication that a huge trend is around the corner, and that that there is the probability of a huge winning cycle in the DWC is around the corner. So those are two ways that you can assess when to increase your allocation in DWC. Firstly, if you see that the returns curve is approaching a historic low, and secondly, by observing open trades under the DWC's trading journal, if you see that they are approaching historic lows as well, or if they are in decline, the likelihood of a major trend in the market increases, and it helps you anticipate a new winning cycle in DWC, which then it makes sense for you to increase allocation in for. I hope that answered your question. Brilliant. Okay. I have another question that I'm trying to open up here. Just a moment. So I have a question from Vitor Oliveira. Nice webinar. I'm a user. If we use the leverage function, I'm sorry, I can't quite see 2 times. So if I'm a user, if we use the leverage function 2 times, what would happen on this one? But Vitor, no, Yenchi has left. Right. Okay, I still can't see the question popping up. Sorry, Vitor's question is, just a moment, please. It seems we have to trade cycles. It seems we have to select cycles for trading DWC is Vitor's question. Apologies for my noobness on GoToWebinar. Yes, so you can trade DWC as in an active manner. DWC appears, as you know from its returns graph, that it's a fairly cyclical asset. By definition, it's going to experience both benign and sweep cycles and act accordingly. So yes, you can visit the behavior data of the DWC. Go through things like, for instance, its most profitable trading days across multiple time frames. You could choose all the way from 2 years to a year, 6 months, 3 months. It gives you an indication of what days in particular could be beneficial for including DWC in your portfolio in an active way. You could actively trade the cycles during those days, or you could be a more of a passive yet active investor where you're waiting for open trades in the DWC's trading journal to go down to a certain point where historically you've seen a new sweep cycle surface and hence a new winning cycle for the DWC. So yes, it is possible to actively trade the DWC using its cycles, if that hopefully answers your question. And it appears I have a question from, right, great question from Edward O'Gorman. We have a question that says, should I have an equal amount invested in DWC as the total of my portfolio? So again, at the end of the day, this sort of falls under investment advice. So at the end of the day, your allocations should make sense. Depending again, if you were to take a look at DWC's trading journal and you're noticing that open trades are in decline, that they're constantly reducing, it gives you more of an indication that a new sweep cycle for the community is around the corner, which means that a new winning cycle for the DWC, the probability of it has increased as well. So as open trades are reducing, or as DWC is approaching a historic low, it would make sense for you to alter your DWC allocation in favor of DWC based on that behavior. Conversely, if DWC is rising, indicating that a sweep cycle is currently underway, if rising aggressively during a sweep cycle period, and that the sweep cycle has been underway for quite some time, open trades are sort of reaching much higher than what they were when the sweep cycle started, it gives you an indication that yes, it's probably time to start reducing your allocation in DWC because the likelihood of a sweep cycle completing in the near future has increased as well. So using that logic and observing the open trades in the underlying trading strategy in the trading journal, as well as the return cycles of the DWC, you can alter your percentage allocation in DWC according to that and exercise your own discretion. Hopefully that has answered your question, Edward. Okay. And thank you for the webinar. So it looks like I have answered all the questions I can see in this window. I'm quickly just going through the list again to make sure that I have done exactly that. And it appears I have. So thank you very much for everyone who attended, and I hope you enjoyed the contents. If you have any questions, please feel free to write in to info@darwinex.com with any questions that you missed asking on the webinar. If you did ask and I've missed answering them, please do forward them to info@darwinex.com, and either myself or someone else will respond to you as soon as possible. Thank you very much for your time and attendance today, and I hope you enjoyed it. See you again very soon.